Hey there, financial adventurers. Ever wondered what makes a stock hard to borrow and why that could matter for a potential short squeeze? Today, we're diving deep into a fascinating microcap stock that's landed squarely on our hard to borrow screener, NCT Intercontinental Limited. Get ready to understand the mechanics behind extreme short interest, sky-high borrowing fees, and what it all could mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about Intercontinental Limited, ticker NCT. This company operates in the industrial sector, specifically within marine shipping. Through its subsidiaries, NCT provides maritime shipping services, including time charter and vessel management, both in Hong Kong and internationally. Interestingly, they are also involved in the processing of pulp, paper, and paperboard products. Show company logo/sector overlay as a microcap stock, NCT is a relatively small market capitalization, making it highly susceptible to significant price movements with even moderate trading volume. Looking at recent price action, NCT has shown some interesting upward momentum. Short chart, NCT 30-day price performance today alone, NCT is up a respectable plus 1.73%. Over the last 5 days, it's gained plus 4.14%, and if we stretch that out to the last 30 days, NCT has climbed an impressive plus 22.65%. This kind of upward movement, especially in a stock with unique borrowing characteristics, often catches our eye. Volume-wise, NCT saw 1,180,100 shares traded today. This is significantly higher than its 30-day average volume of 688,736 shares, giving us a relative volume of 1.7x average. Show volume bars. This increased activity, combined with the tiny estimated float of just 0.3 million shares, really sets the stage for our discussion. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? In simple terms, it's the annualized fee that short sellers pay to borrow shares of a stock. When you short a stock, you borrow shares you don't own, sell them, hoping to buy them back later at a lower price to return to the lender, profiting from the difference. But borrowing isn't free. The CTB is essentially the interest rate you pay on those borrowed shares. Why does it matter? Because it's a direct indicator of demand from short sellers and, crucially, the available supply of shares to borrow. A high CTB means either many people want to short the stock or there are very few shares available to borrow, or both. And yes, CTB fees can easily exceed 100% annualized. This doesn't mean you pay 100% every day, it's an annualized rate. But if the daily fee is, say, 1%, that compounds to a massive annualized rate, reflecting extreme scarcity and high risk. These fees eat into a short seller's potential profits, and if the stock price moves against them, they can get squeezed. Why this stock is hard to borrow right now. Now let's bring it back to NCT. Our hard to borrow screener flagged NCT with an astonishing cost to borrow fee of 677.5% annualized. Highlight 677.5% CTB. This is an incredibly high number, signaling that shorting Intercontinental Limited is currently an extremely expensive proposition. Such a high CTB typically points to either very strong demand from short sellers to bet against the stock, or, more commonly in cases like this, a severely limited supply of shares available to borrow. Considering NCT estimated float is a minuscule 0.3 million shares, it's not hard to see why shares would be scarce. With such a tiny float, even moderate short interest can make borrowable shares incredibly difficult to find. Our data also indicates that the shares currently available to borrow are unknown, which further emphasizes the scarcity. This lack of transparency often means brokers have few, if any, shares on hand to lend out. Our internal composite squeeze score, which combines factors like CTB level, borrow supply, float size, and price momentum, gives NCT a score of 42.5 out of 100. While not the highest score we've seen, the extreme CTB and tiny float are significant factors here. It's important to remember, though, that a high cost to borrow does not guarantee a short squeeze. It can also mean short sellers have very strong conviction that the stock will go down, and they are willing to pay a premium to maintain their short positions. Squeeze mechanics explained. So, what is a short squeeze? It happens when a stock's price rises sharply, forcing short sellers, who have bet against the stock, to buy back shares to close their positions. This buying pressure then pushes the price even higher, trapping more short sellers and forcing them to cover, creating a vicious cycle upwards. When a stock like NCT has such a high cost to borrow, it significantly increases the pressure on short sellers. Every day they hold their short position, they're bleeding money in fees. If NCT price continues its upward trend, remember that plus 22.65% in 30 days, these short sellers face a double whammy: mounting losses from the rising stock price and expensive borrowing fees. If the supply of borrowable shares dries up completely, it becomes impossible for new short sellers to enter, and existing ones are cornered, unable to find shares to borrow even if they wanted to re-establish their positions. This is where a tiny float like NCT 0.3 million shares becomes a critical factor. If enough short sellers start to cover the limited number of shares available in the market, can lead to incredibly rapid price appreciation. Dilution risk check. A crucial factor to consider for any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can often happen through SEC filings like S-1s, S-3s, or 424Bs. For NCT, we found no recent dilutive SEC filings in the last 90 days, which is a positive sign for squeeze thesis. We also checked for reverse splits, which can sometimes precede dilution or affect share structure, and found no recent reverse split for NCT in our look-back window. Why does dilution matter? Because even if the cost to borrow is sky high, new shares hitting the market can flood the supply, giving short sellers ample opportunity to cover their positions without driving up the price. It can effectively absorb or negate any buying pressure from short covering, often killing a squeeze thesis. The absence of recent dilution for Intercont Cayman Limited means one major hurdle to a potential squeeze is currently not present, making the low float and high CTB even more significant. Again, a quick reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For NCT, Intercont Cayman Limited, given its unique setup, here's what you'd want to keep an eye on. First, continue monitoring that cost to borrow fee. Is it staying consistently high, or even climbing further? Show CTB meter any movement towards even high fees would indicate continued scarcity or increasing short interest pressure. Second, pay close attention to the supply of borrowable shares. If it remains unknown or tightens further, it increases the pressure on short sellers. Third, watch the volume. Today's 1.7x average volume is already notable. A sudden surge in volume, especially on strong upward price movement, could signal short covering. Fourth, track NCT price action. Continued upward momentum, particularly if it accelerates, would be key. Fifth, given its sector in marine shipping and also paper products, any industry-specific news or company announcements for Intercont Cayman Limited could serve as catalysts. Remember, with a tiny float of just 0.3 million shares, NCT is particularly sensitive to any shifts in supply and demand dynamics. In summary, NCT, Intercont Cayman Limited, presents a compelling case study for hard-to-borrow stocks. As a microcap in marine shipping, boasting an astronomical 677.5% annualized cost to borrow and an incredibly tight estimated float of only 0.3 million shares, it certainly stands out. The recent price appreciation and lack of immediate dilution risk add further layers of interest. While high borrowing fees and a tiny float do not guarantee a short squeeze, they certainly create a volatile environment where one could potentially unfold if enough pressure builds on short sellers. We hope this deep dive into NCT has helped demystify what it means for a stock to be hard to borrow and the mechanics behind a potential short squeeze. If you found this video insightful, please hit that like button, subscribe for more unique stock analyzers, and drop a comment below with your questions or what stocks you'd like us to cover next. Until then, happy researching and stay informed.